Welcome back to the U.S. Stock Picker podcast channel. Today, we are taking a slow, deliberate look at a major market event that has caught many investors off guard. On June 26, 2026, Apple experienced a sharp correction, with its stock price dropping over 6% in a single session to close at $275.15. This is a significant moment because it represents a sudden shift in how the market is valuing one of the world's most prominent technology leaders. After weeks of post-WWDC excitement, we are seeing a cold dose of reality. The central question we must ask ourselves is whether this is a temporary bump in the road or the beginning of a much deeper trend reversal.
It is a critical question. When you look at the sheer scale of the sell-off, with over 102 million shares changing hands, it is clear that institutional investors were actively moving capital. This was not just retail panic. It was a heavy volume distribution day. The immediate catalyst behind this sudden drop is a combination of rising hardware costs and a sudden reality check on profit margins. Apple recently announced price increases of 20 to 25% on its new Mac and iPad models. While the company points to a severe, once-in-a-century spike in memory component costs due to the massive global AI infrastructure demand, the market is reacting with deep concern. Investors are worried that these steep price hikes will hurt consumer demand and lead to a significant drop in actual unit sales.
That concern about consumer behavior is key. When a company raises prices so sharply, it tests the limits of its brand loyalty. For years, the narrative around Apple has been its incredible pricing power. But now we are seeing the market demand proof. It seems the initial excitement from the latest developer conference has worn off, and we are entering a classic sell the news phase, and the long-term AI story is still there, of course, but the market is suddenly focusing heavily on near-term margins. How do you see the technical damage after this drop?
The technical damage is indeed substantial. The stock has broken clean through its 50-day simple moving average, which was sitting at $291.06. That level has now flipped from a reliable support area into immediate overhead resistance. During the intraday trading session, the price also slipped below the 100-day moving average of $275.84. Right now, the relative strength index is hovering around 32, which is getting close to oversold territory. Normally, a low RSI suggests a bounce might be coming, but because the selling volume was so high, it indicates the market is still searching for a solid floor. The absolute line of defense for the long-term upward trend is the 200-day moving average, which currently sits at $268.82.
So we are looking at a market that is no longer willing to buy the long-term AI narrative blindly. They want to see how these memory costs impact the bottom line. It is a transition from pure optimism to a show-me phase. This brings up an interesting point about market psychology. When supply chain pressures like this hit, some analysts remain fiercely optimistic, while others quickly downgrade the stock. We have seen firms like Goldman Sachs and KGI Securities lower their outlook to neutral and hold, while others like Wedbush are holding onto their bullish targets, calling this a temporary overreaction. How should an active trader process these conflicting signals?
The best way to process this is to focus on the price action and volume, rather than the noise. In a high volatility environment like this, chasing the stock on the opening bell is incredibly risky. That is why we emphasize the no-chase rule. When a stock is falling on high volume, you have to let the market settle and establish a range, particularly in the first 30 minutes of the trading day. If the stock continues to make lower lows on elevated volume, it means institutional selling is still active, and you should stay on the sidelines. A safe entry for a short-term trade requires volume to contract significantly, which shows that the selling pressure is finally exhausting itself.
That makes perfect sense. It is about patience and waiting for the dust to settle rather than trying to catch a falling knife. Let us look at this from a strategic perspective. If we break down the current landscape, what is the definitive action plan for different types of investors who are looking at Apple right now?
Let us break it down systematically across news sentiment, fundamentals, swing trading, and specific entry and exit price points to mitigate risk.
First, looking at the news sentiment analysis, the current sentiment is distinctly negative. The market has shifted its focus from the long-term potential of AI integration to immediate concerns about hardware profit margins and consumer demand elasticity. The 20 to 25% price hikes on Macs and iPads have raised fears of a volume contraction.
Second, for the fundamental and strategy analysis, the long-term investment thesis remains solid. Apple's massive ecosystem lock-in and growing services revenue are still incredibly strong. The current price drop is a reaction to temporary supply chain bottlenecks and a surge in memory component costs, not a structural failure of the business model itself.
Third, for the swing trade analysis, the setup is currently in a high volatility breakdown. The stock has transitioned from a consolidation phase to a bearish short-term posture. We have a potential 5 to 6% upside compared to a 2 to 3% downside risk, but execution must be highly disciplined.
Fourth, regarding the buy and sell recommendation of when to start investing, the overall rating sits at 55 out of 100, which is a neutral hold. For long-term investors, the recommendation is to do nothing and hold your existing positions. Do not panic sell. If you are looking to buy for the long term, wait for a deeper discount. For swing traders, the recommendation is to stay sidelined and wait for a clear higher low to form on the daily chart before deploying new capital.
Fifth, let us look at the exact price points to start investing. If you are a long-term investor looking to add to your position, the ideal price point to start investing is between $250 and 255 cents, as this represents a significant discount to the stock's intrinsic value. If you are a swing trader, the target entry trigger is between $273 and $275. However, you must wait for a daily close above $275 accompanied by a lower wick reversal candle to confirm that buyers are stepping back in.
Sixth, we need to address when to leave the market to protect your capital. If you are currently holding a swing position or looking to enter one, you must have a clear exit strategy if the trade goes against you. You should leave the market immediately if the stock fails to hold its critical long-term support level.
Seventh, the specific price point to leave the market at to mitigate risk is a hard stop loss set at $268 or just below at $267.50. The 200-day moving average at $268.82 is the final line of defense. If the stock closes below this level, the medium-term bullish thesis is completely invalidated and you must exit to preserve capital. On the upside, your target price point to leave the market and take profits is between $288 and $290, where you should scale out as the price approaches the former 50-day moving average resistance.
That is an incredibly clear and structured roadmap. It highlights the importance of keeping emotions out of trading and relying strictly on key support and resistance levels. The contrast between short-term volatility and long-term value is something every investor has to grapple with, especially when dealing with a market giant. It reminds us that even the strongest companies are not immune to supply chain shocks and shifts in market sentiment. As we watch the market digest these new hardware prices and the reality of memory component costs, patience seems to be the most valuable asset an investor can have right now. Thank you for sharing these deep insights and helping us navigate this complex setup.
It is always a pleasure. In markets like this, letting the market prove itself to you is the safest path to protecting and growing your capital. Clickbait video title: Apple stock collapse. Why AAPL just crashed and the ultimate swing trade guide, stock stow trade podcast, growth stock picks, upside potential stocks, technology stock predictions, pop stocks. The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.